Welcome, ladies and gentlemen, to AskOkey. Today we're going to take a slight departure from our customary conversation or discourse on classic dress, and we're going to talk about money. More specifically, we're going to be talking about banking and finance. Now, let me take your memory or attention back to our introductory video where we talked about the 4 pillars of our blog. We talked about classic dress, we talked about banking and finance, we talked about philosophy, and we talked about fitness. And so today we're making our entree into the second purview, which is economics and finance. And more specifically today, we're going to be looking at finance, banking, and their roles in our lives and the economic system. So without further ado, let's get into it. Now, before I start, I want us to walk away from this conversation, or this monologue as it were, with 2 key objectives. 1, a fairly good understanding of what banking is and the role of finance. And 2, why you should care. So do bear those 2 things in mind as we go into the body of our presentation. Now let's talk about money and the role of money. What is money and what is its role? There are 3 functions of money from a classical economic standpoint. 1 is as a store of value, 2 is as a medium of exchange, and 3 as a unit of account. Now, let me unpack this. Clearly, value needs to be stored. Centuries ago, transactions were done by barter. Now, the problem with that was that you couldn't store value. You could only exchange a good for a specific other good or service you needed at a specific point in time. And if you had excess goods and there was no demand for it, you couldn't convert that value into money. And so we came up with a medium that allowed us to exchange value through trade and then to store that value once the exchange has been concluded. So these are the 2 primary functions of money, as it were. 1, as a medium of exchange, a way to barter your service or your product. And 2, to store that value once that exchange has occurred. Now, the third and more classical function of money is as a unit of account. And what does that mean? It means that certain goods and services produced in different currencies or in different jurisdictions have a certain value. And for these goods to be universally tradable, there needs to be a unit that pegs a value regardless of where these goods and services may be produced into a single unit. And that allows for a fair exchange of those goods or services regardless of the region or the jurisdiction or production or origination of that product or service. And so that is the third function as a unit of account. So let's recap again. What is the function of money, or what are the functions of money? 1, as a store of value. 2, as a medium of exchange. 3, as a unit of account. Now, let's go into the role of banks. What are banks and why do they exist? First, let me say there are different types of banks. You have, of course, central banks. You have commercial banks. And then you have investment banks, under which you have merchant banking, brokerage, and a whole bunch of other things. And we're not going to go into all those details. I just want to focus on the key elements of banking. Now let's talk about banking and why it's important. What is a central bank? A central bank is a monetary organization. Its mandate is to manage an economy or an economic system. But how does it do this specifically? A central bank has two key mandates. One, price stability, and two, maximum employment. And what do these mean? Let's talk about price stability. Price stability means managing inflation, using interest rates and money creation as tools or as a tool to manage inflation. Because in any functioning economy, inflation needs to be properly managed. Two, maximum employment. For those of you who are better versed or very well versed in economics, you've heard of the Phillips curve, and which is the point of maximum employment beyond which the system starts to create inflationary pressures. Now, classically, that number has been about 5.5% unemployment or thereabout. In other words, no functioning system can ever be fully employed. Otherwise, you're going to have wage inflation. And so the job of the central bank is to monitor unemployment or employment numbers and ensure that they stick somewhere around that recommended rate on the Phillips curve of about 5.5%. It certainly drops below that. I think currently we're even below 5.5%, probably somewhere in the 4% range. However, it cannot deviate materially from 5.5%, which is the optimal number on the Phillips curve. Now, let's go back up so we don't drift too far into the arcanity of economics. So that's central banks. Now, let's talk about commercial banks, meaning your JP Morgan, your Citibank, your HSBC, deposit banks, I like to call them, where you go to deposit your money. Those are called commercial banks. Now, let's talk about their roles. They have three main functions. One is creation of money through fractional lending, or specifically, fractional reserve lending. Two, of course, is safeguarding your money, unless you prefer to keep your money under a mattress or under your pillow, or dig a hole in your backyard. And three, transaction services, in other words, facilitating the exchange of goods and services by creating a functioning financial plumbing system. So those are the three key roles of commercial banks. Now let's talk about them from top to bottom. Money creation through fractional reserve lending. I will not go into the detail, and I will leave that for another lecture or for another segment of how exactly fractional reserve lending works. However, I will say that commercial banks essentially have a license from the central bank to print money or to create money. And they do this by fractional lending, by providing credit. And that credit grows and creates economic activity that causes economic output to increase. And so it is the role of the commercial banks, mandated, of course, by the central banks, to play this role of money creation in the economy. And that's why they provide you your credit cards, your mortgages, your car loans, your student loans, and all whatnot. So that is money creation. Second role, of course, is safeguarding your money. And that is fairly simple. You don't want to be keeping all your money under your mattress or under your pillow. And so you take it to the bank. And they typically don't store it in a vault, contrary to what many think. No, your money is not, if you go to the bank today, you're not going to see your money in a vault. And I will get into the details of how that works in another lecture or in another segment. But today, let's just say that the role of the bank is to safeguard your money and to provide an alternative, a secure alternative for guarding your savings. The third, of course, is facilitating financial transactions, or using a more technical term, financial intermediation. And so you have credit cards, you pay your bills, you transact between one another, and the system on which this works is managed by the commercial banks. And so when you purchase something, one commercial bank debits your account and credits another account, and so on and so forth. And so there's electronic systems that ensure this, such as SWIFT, and so on and so forth. But again, I want to avoid the arcanity and focus on the subject or the purpose of this presentation, which is a high level of an understanding of banking, finance, and how money works. So that's commercial banking. Now, we're going to get into investment banking, which is going to be the main subject of this conversation today. Investment banks have two roles, essentially. One, capital allocation and providing financial advice, typically to companies and large corporations. Sometimes to individuals, high net worth individuals in their private wealth management or private banking services. But suffice to say that their key role is to allocate capital and advise mainly corporations on how to optimize and use this capital. So that is the high-level overview of what money is, what banks are, what banking is, the different types of banks we have in the system, and what exactly they do. Now, we're going to go into investment banking because, of course, as I mentioned in my introduction, I'm a veteran investment banker. I spent many years on Wall Street. And I want to use this opportunity to share a little bit, provide a little bit of insight into the functions or the functioning of an investment bank. And why am I doing this? Some of you might say, well, I don't really care about investment banking. I'm not a banker. I never will be. But a lot of us are interested in investing or investment. And so it's important for us to understand how investment banking works. And with that understanding, we have a basis for approaching our individual or personal investment objectives. And so let's get to it. What is an investment bank and what is its role? There are 5 main roles within an investment bank. One is advisory, as we mentioned in the short introduction of investment banking. The second is capital markets, meaning a market for raising capital. The third is sales and trading. The fourth is asset management. And the fifth is research. Now, we're going to unpack all 5 of them one at a time, and we'll start at the top. Advisory. So what is advisory? Advisory, or more specifically, in industry language, called investment banking. This is all investment banking, by the way, but within investment banking, advisory is called investment banking. I'm not sure exactly why, but that's what it's always been called. And within advisory, you have mergers and acquisition. We have a book here on M&A, if you look closely on the table. Mergers and acquisition, advisory, which includes capital structuring. In other words, advising corporations on how to go about raising capital. How much debt, how much equity they need to achieve their corporate objectives. And obviously, this is all driven by so many different factors, including the cost of money or the optimal cost of money. They also provide tax advice in some cases to corporations. And I said earlier on capital efficiency. In other words, what blend of capital between debt and equity and other sorts of capital provide the most optimal outcome for a corporation looking to finance itself or finance its activities. So that is advisory. We move on to the next function, capital markets. And as the name indicates, capital markets literally means a market where you go to raise capital. And what are types of capital that you raise in the capital markets? You have debt, which is essentially a loan, money you have to pay back. The only difference is that whereas when you go to a bank to borrow money, it's a loan. Investment banks help you raise capital, debt capital, in the capital markets by issuing bonds or fixed income instruments. These are also loans, by the way. You have to pay them back. They're just loans that are originated not from banks, but from either institutions, institutional investors, or even individuals. And so it's money that you borrow that has to be paid back. The second type of capital is equity, of course, or stocks. Stock. Some of you would understand what stocks mean. So when you buy equity in a company, you're essentially buying a piece of that company. You're buying a piece of its cash flows into perpetuity, literally. So when you invest that money, it is not paid back. You earn dividends. If the company pays dividends, you're entitled to a share of the company's dividends into perpetuity. And you're permanently a stakeholder or a shareholder in this company. So that's equity. Other things investment banks do are things like structuring derivatives. And what are derivatives? Derivatives are instruments basically that derive their value, as the name suggests, from an underlying asset. And so usually these underlying assets are either stocks or bonds or commodities, which we haven't talked about. However, a derivative instrument has no intrinsic value besides the value that it derives from the underlying asset or security. And so why do we need derivatives, or why do investment banks create derivatives? Typically, they're used for hedging. And the hedging is sort of another word for risk management. So corporations might have a need to hedge a certain type of risk, perhaps an exposure to commodity risk or prices, or perhaps they want to hedge their stock. So one of the functions of an investment bank is to create these derivatives by establishing counterparties that are willing to take on that risk. Or sometimes the investment bank takes on the risk itself. And the customer, in this case, the corporation, pays a certain premium, an insurance premium, if you will. So look at it almost as your insurance on your house or on your car. It says, I'm willing to pay a little premium to protect the value of this asset. And that is really what derivatives are. And that is one of the functions of the capital markets division within an investment bank. We fast forward to the next one, sales and trading. Now, when the money has been raised in capital markets, it needs to be traded. You need to provide liquidity to your institutional investors. So let's say, for instance, you raise debt for a corporation and those bonds are purchased by, say, a mutual fund or a pension fund. They might be willing, or they might seek to trade out of those bonds in 2 years or 3 years. In other words, they might wish to sell them and not hold those bonds to maturity. Let's say it's a 10-year bond or a 20-year bond. For some reason, perhaps for strategic reasons or internal reasons, they might wish to sell those bonds after 5 years. And part of the job of the investment banker is to provide a liquid market that ensures that they're able to sell those bonds and redeem their value for those bonds. And that is what the sales and trading department of an investment bank does, is to manage these transactions between the institutions and the marketplace, and to ensure that there's always sufficient liquidity in the market for fluid transactions for these investors who purchased these bonds and stocks and derivatives as well. The fourth is asset management. That is very, very clear and straightforward. Asset management means what it means. It's a function within an investment bank where either institutions, meaning pension funds and so on and so forth, retirement funds, hand over their money to places like BlackRock, PIMCO, Vanguard, And the list goes on. I mean, there are hundreds, thousands of asset managers out there. But the job of the asset manager, or his or their mandate, or its mandate, is to manage these funds that have been placed in its hands or in its trust by these institutions, pension funds, and so on and so forth. And so that is asset management. Also within asset management, of course, they cater to very high net worth individuals, called private banking or private wealth management. And these are individuals that have large sums, large estates that need to be institutionally managed, that they can't manage themselves from the kitchen table. So clients like this are customers to the asset management divisions of investment banks. Last but not the least is research. Research is a very critical function within an investment bank, and it supports all the other four above: advisory, capital markets, sales and trading, and asset management. And why is it important? Because research is what it means. It literally does what it says on the tin. It does research. And so you have a bunch of analysts, very sophisticated, very often with PhDs and doctoral degrees. And their jobs are to conduct research either on industry or segments of the industry on specific companies. And their job is to uncover trends and to see where things are headed. In other words, they are the Moses of the investment bank. Their role is to look into the future and see where things are headed, and then advise the other units within the banks to adjust their strategy, or within the investment bank to adjust their strategy. So let's say, for instance, we have a chip shortage, something that's been plaguing the economy or the global economy for the last 6 months or about a year. And this affects production, affects supply chains, affects inventory, and all these other things. And these things all have a domino effect on the value of a company. Because if you lack inventory, or if you have your supply chain compromised, then you cannot sell your products. And if you're short on revenue, it's going to affect your profitability and ultimately your stock price or your share price, and investors suffer. And so the role of research is to see these things before they come and to warn the investment bankers, the other divisions, to advise their clients on appropriate measures to take to hedge such an eventuality, a risk. And this is where, say, a product or two like derivatives come in. Digging a little bit deeper, and forgive me if I'm venturing into arcanery here. So let's say we have a chip shortage, and you are Apple, and chips are a lifeblood of your business, because each of these devices has a chip or sort of a set of chips in it. And so it's a lifeblood of your business. And so one, you want to ensure that you have steady supply, and you want to ensure that your prices are stable. Otherwise, they're going to compromise your profit margins. And so what do? The research analyst advises Apple's investment banker, who now goes to Tim Cook and says, listen, Tim, we got a problem. There is an acute chip shortage building up, and we have to do something about it. And so one way Apple might hedge about that is to buy forward contracts, or to enter into forward contracts. In other words, they're going to sort of procure chips ahead of when they actually need them. And these are called forwards or futures. And that way, they ensure that they have a steady supply of chips at a defined price today. And typically, they would have to pay a little bit of a premium for that insurance. But most importantly, they have de-risked their inventory or supply chain by assuring that a chip shortage, an impending chip shortage, will not compromise their production. And so that is what research does. Research is a very critical function within the investment banking complex, and they support the entire platform. So that is it for investment banking. In the next segment, we're going to talk about commercial banking, which is a much wider subject. But today, I wanted to spend a little bit of time, about half an hour, talking about money, how it works, and more specifically, investment banking, its role, and why it's important to us. And so in conclusion, we've gone through this exercise to understand that as individuals, when we go into the marketplace to invest, every stock we purchase has gone through a process. Basically, it's a manufactured product, and it's manufactured by the investment banks. And what we've done is that we've unpacked the value chain or the supply chain of this product from origination as an idea. Someone has an idea, they want to build a company, they go to an investment banker to raise money. The investment banker goes to investors, raises that money, and then creates a market for them to trade the stocks that have been issued. And then you and I, as the end investors, we go into the marketplace, we either buy shares of these mutual funds and own these stocks indirectly, or we actually directly go into the marketplace and buy the shares of these companies ourselves and trade them. So that is how the stock that you own in your portfolio or that you trade, for those of you who are day traders, that is the process and means through which it is essentially manufactured. And with that, I would love to bring this session to a close. I hope it's been useful. I hope to spend some more time in future segments talking about money, looking into deeper subjects within finance, options, derivatives, option trading, for instance, a bit higher on the sophistication spectrum. But before we get there, I would like to spend a few segments talking about the basics and the fundamentals of money. So thank you once more for joining us for this segment on money, on finance, on banking. And I look forward to seeing you on the next episode of AskOkey. Thank you, ladies and gentlemen, and goodbye.